Hi guys, welcome to a past question a day. My name is Shadakopoko Frempong, and today we'll be looking at ratios and analysis. So, Gbana Limited, a holding company operating in the IT industry, is considering diversifying its investment portfolio by acquiring a subsidiary in the healthcare sector. Two companies, that's Buchanan Limited and Plido Limited, have been identified as the potential acquisitions. The following draft financial statement relates to the Buchanan Limited. So we have the income statement where we have the revenue, cost of goods sold, gross profit, other income, operating expenses, profit before tax. Then we have our net profit. Then we have our retained earnings. You realize that our retained earnings is the same as our profit after tax. Indirectly, we are being told that no dividend was paid. No dividend was paid. Okay. Moving forward to our balance sheet, we have our non-current assets, which is made up of our medical equipment, intangible assets. Our current assets, we have our inventory, receivables, bank balance, and our cash balance, giving us our total assets. And then we move to the equity and liabilities. We have our share capital, retained earnings, long-term loans, accounts payables, and income tax payables. Now let's go to the additional information. So the board of Banana Limited, at its most recent meeting, engaged the services of a consultant to perform a due diligence on the financial affairs of Buchanan Limited. From the due diligence report, the following were reviewed. 1. 10% of the sales of Buchanan Limited in 2024, which is 700,000 Ghana cedis, were made to Queen Limited, which has wound up, and these sales remains unpaid. So then we have a receivable that we have to write it off. We may have to reduce our revenue to reflect the ones that we would receive. 2, the closing inventory included third-party inventory costing 100,000. What it means is that our closing inventory value reported in our balance sheet includes 10,000, which belongs to another organization or a third party. So you may have to revise it or correct it. 3, 5% of account receivables making up 40,000 Ghana cedis should be written off as bad debt. So our receivable will go down further by 40,000 Ghana cedis after we have reduced it by the 700,000 and the first additional information. The following ratios have been computed for Plido Limited and one of the targets of the acquisition. So we have our gross profit margin, our operating profit margin, return on capital employed, quick ratio, current ratio, debtors collection, creditors, net asset turnover, debt to equity ratio, and our capital gearing ratio. Some of these ratio comes with its formulas attached. So that's good news for us. Required. Show the adjusting entries to reflect the due diligence findings. That's the first one, going for 4 marks. And the second one, compute the comparable ratios of Buchanan Limited based on the due diligence findings. What it means is that we have to inculcate the due diligence findings. We may have to redraft the income statement and balance sheet again before we go ahead to compute the relevant ratios. C, prepare a report to the board of Banana Limited using the ratios computed in B. Since the two projects are mutually exclusive, advise the board whether to invest in Buchanan Limited or Plido Limited. Okay, so let's just go deep into it. We can start with solution. We can start with the first one, A. We said we should show the adjusting entries. We have 700,000, which has gone bad. So we may want to reduce our sales value to reflect the actual sales that we can collect or that is collectible. So we are going to debit our sales value, 700,000, and we are going to credit. So let me just bring, then we are going to credit our receivables. So also 700,000. It's a comma. That's for the first one. Then the second one, we have inventory that belongs to a third party, which has been reported in our books. So we have to take it off. And we are going to do that by reducing our closing inventory in our balance sheet. And also it's going to affect the cost of sale or cost of goods sale we have in our profit or loss statement, because closing inventory is deducted from that side before we arrive at what our cost of goods sales or our cost of sales. So we have our cost of goods sold, which is 100,000. Then we are debiting it. Then we are going to credit our closing inventory reported in our balance sheet, also 100,000. Then we move on to the third one. We said 40,000 should be written off from our receivables as bad. So C, we are going to debit our bad debt account, or let's say we are going to debit our P&L, 40,000, and we are going to credit our receivables, 40,000. Then we are done. So the first one has been resolved. We are now entitled to our 4 marks as indicated by the examiner. Now let's move on to correcting our profit or loss statement and also our statement of financial position. We may just want to glance through our figures and have them offered. So our revenue, cost of sale, stuff, gross profit, okay. We just want to add some few pages. Okay. All right. So let's call it our revised income statement. So we have our revenue, which is 7 million minus 700,000, giving us 6.3 million. So our revenue is going to be 6.3 million. For our cost of goods sold, it is going to be what we have, it is 20,300. So 3 zeros up. Let me just put 3 zeros up. Plus the 100 that belongs to someone that was deducted. So we now have 2, and this will give us a gross profit of 3.9 million. So our gross profit. Then we move on to our other income, which is 50,000. Then we recognize our expenses. So we have salaries, 1150. It's an expense, so let's recognize it as such. Utilities, we have 150. We have maintenance, 50. We have depreciation, 250. We have bad debt that we introduced, 40,000. We have admin, which is 550. We have our interest, which is 150. And this is going to give us a profit of 1510. Then we can also recognize our taxes. So this is profit before tax. And we have our tax, which is 950. Then this gives us a profit after tax of 560,000. So profit after tax. Now we can move on to our statement of financial position, our revised statement of financial position. So we are going to maintain almost everything with the exception of the ones or the items that was adjusted. So revised balance sheet. So we have our non-current assets, made up of our medical and our intangible. So our medical is 3,300. Our intangible is 320, giving us a total of 3,620 for our total non-current assets. Then we move on to our current assets, which is made up of our inventory. Now our inventory, we have to deduct. So we have 650,000 and we have to deduct the one that belongs to the third party. So this gives us a total of 550. Just push it a bit up. Okay. Then we have our receivables. Our receivables being 800,000 minus the 700 minus the 40, giving us just 60,000. Then we have our bank and cash balance. So our bank, 1.2 million, and our cash being 50. So our total current assets is going to be 1860, giving us a total asset of 5480. The total assets now let's move to the equity and liability part of things. So for our equity, we have our share capital, which is 2,000,002 million. Then we have our retained earnings. The trick here is that we are going to pick our retained earnings, which is 3 million. I'm going to take 3 zeros off because of space. Then we deduct the profit of our statement or our report before the due diligence was conducted. And our profit is 1.4 million. So we are going to deduct it. 1,400. Then we are going to rather add the profit that we had from our revised income statement, which is 560. And this is going to give us 2,160,000. So we have a total equity of 4,160,000. That's for our total equity. So we move on to our liabilities. Okay. So for our liabilities, our non-current liability or our long-term liability, we have some long-term debt or long-term loan, which is 950. And for our current, we have our payables, which is going for 250. And we have taxes going for 120. This is giving us a total liability of 1,320,000. This is total liability. If we are to add it to our equity, we will be having 548,000. And this is our total equity and liabilities. Liabilities. So after the revised statement, we are now going to prepare our ratio report. And we first have to start by computing our relevant ratios. Let me just add some few more pages. Okay. So for the ratios, we are going to compute the ratios that were given to us from the other organization. So the first one is going to be our gross profit margin. Which is our gross profit over our revenue times 100%. Our gross profit, we had 39,000 against our revenue of 6.3 million times 100, which is going to give us 61.90%. Two, our operating profit margin, which is our earnings before interest and tax, that is EBIT, over our revenue times 100%. So we have our 1.660, revenue of 6.3 million times 100%, giving us 26, giving us 26.35%. Then we move on to the third one, our ROCE rate, that is return on capital employed, which you can easily even derive the formula from its name, return from capital employed, meaning the returns we have been able to ascertain or derive from the capital we have employed in doing our business. So it is our earnings before interest and tax over our capital employed. And our capital employed is the same as our net asset or our equity plus our long-term debt. So you move to your balance sheet, you add your equity plus your long-term debt, or your total assets less your current liability gives you your capital employed. So we have our earnings before interest and tax being 1660 over our capital employed, which is 5110 times 100, giving us 32.49%. Now we move on to the next ratio, which is our current ratio. And this is our current assets over our current liabilities. N is to 1. So our current asset is 186,000 over 370 is to 1. And our answer is 5.03 is to 1. So for every 1 cedi liability that we have assets worth 5 cedi to take care of it. Now we move on to the next one. That is our quick ratio. So quick ratio is just like our current ratio, just that we have to deduct our closing inventory from our current assets and still see if we can be liquid. So current assets minus inventory over current liabilities. So we have our current assets, which is 186. Then we are going to deduct our closing inventory, which is 550. It used to be 65, but we were told that 100 belongs to someone. So 186 minus 550. So let me just write everything. 1860 minus 550 all over 370 is to 1. And we are getting 3.54 is to 1. So for every 1 CD liability that we have, current liability we have 3 CD, 54 pesos to take care of it. Now let's move to our debtors collection period. How long it takes us to collect our debt. Debtors collection, which is our receivables over our revenue, because you have to sell and sell on credit before you have debtors, times 365 days. So our receivable is 60,000 over our revenue of 6.3 million times 365, and our debtors collection days is 3.48 days. Now let's look at that of our payable days or our creditors payment days. So payable so payable collection, that is made up of our payable. And how do we get payable? By purchases, right? In this case, we were fortunate we were given the purchases. If we were not given the purchases, we would have gone ahead to use our cost of sales. But we were given the purchases. So times 365 days. So that makes it 250,000 over 2.5 million times 365. And our answer is 36.5 days, which is bad because it takes us 3 days, which is actually good. It takes us 3 days to collect our money from those who are owing us, and it takes us 36 days to pay. So we can just work with the money for some time. Now let's move on to the next ratio. That is our net asset turnover. Net assets turnover. And this is our revenue over our net assets, and it's in times. So our answer will be expressed in times. Because I wrote at the header, that is why my thing has disappeared, but that's fine. So our revenue is 6.3 million. And our net asset is 416. So that is going to give us about 1.51 times. Then we move on to the next one. That is our debt to equity ratio. So debt to equity ratio. And I think this is a bit straightforward. So we mean our debt over equity times 100. And when we say debt, we mean our long-term debt. So long-term debt, let me just write debt in full over our equity times 100. So this is going to be 950. That is the long-term loan over our equity, which is 4160 times 100. That is 2284%. Then we move on to the last ratio, which is our capital gearing ratio. So capital gearing ratio. And as the name goes, capital gearing ratio. So the focus will be on our debt to our capital structure. We want to just know the percentage of our capital structure that relates to debt finance. So our debt over our equity plus debt. We know our debt is 95000 and our equity is 4 million, a little above 4 million, plus our debt times 100. And this is going to give us 18.59. So if we pick our total capital structure, there is a debt component of 18.59. We will end here, and I am going to put a link in the comment section that you will have access to the solution and also the reports and recommendation that is made to the board. Thank you for watching. See you in the next video. Bye.